Welcome to this video brought to you by Aswat Tax. My name is Omar Aswat, Chartered Tax Advisor. In this video, I'll be talking you through a case study. So one of our clients, as in husband and wife clients of ours, where we assisted them over a period of 4 to 6 months in terms of their property tax matters. Before we go on, don't forget to like, comment, share and subscribe to our channel, where we'll bring you regular content in relation to UK tax. As a firm, very quickly, we do assist high net worth individuals, property landlords and business owners, individuals coming to and leaving the UK. Don't forget to visit our website, which is down below. So if we set the scene, what we had is husband and wife. They owned 13 properties in total, plus 13 properties plus their main residence, so 14 properties in total, and 2 of these properties from the 13 were commercial properties. Now, they've owned these properties since they began building their property portfolio since the early 2000s, okay? And these properties have always been held in their personal capacity. It's always been 50-50, husband and wife, but every single tax year they had been declaring the income on the personal self-assessment tax returns. And they were also receiving other income. So over the years until now, they receive other income. Why? Because they have 2 trading businesses as well. So they receive a salary, dividends and that kind of thing. And the rental income has basically been suffering personal tax at 40%, okay? Between husband and wife, they've been paying UK income tax at 40%. Now, following the introduction from their accountants, and we also work closely with professional intermediaries such as accountants, law firms, where we assist the accountancy firm, for example, in servicing their clients' tax needs. The accountancy firm effectively introduced them to us. And the starting point for me especially is the initial discussions. So it's never a blanket approach where, we see husband and wife landlord and we just say, okay, we need to incorporate. We'll come to the incorporation very shortly, but it should never just be, okay, let's incorporate, or my friend incorporated and therefore I should be incorporating too. It doesn't work like that. It's very important that every individual and family circumstance is analyzed and assessed on a case-by-case basis. So that's how we start. So effectively, we have a fact-finding Excel document, and that's where we obtain the initial information. And from there, we get on a call and we understood for this particular client, I was on the call and I particularly understood the affairs of the clients. Okay, when I say the affairs, I mean, okay, what are your long-term plans? That's always like an initial question, which is, okay, you're here right now. Where do you intend to get to? As in, what are your plans? What objectives are you trying to achieve? And I think a lot of that information effectively drives the tax planning. It shouldn't be the other way where, as in yes, everybody wants to save tax, right? So that is a key driver, but what I'm saying is it should be in line with the wider objectives, because then we can throw out 50 solutions, okay? And the solution might save you tax, but you lose control, for example. Okay, so there are a lot of different angles that need to be analyzed and assessed. Following from there, we undertook an initial tax analysis, so what can be done, what can't be done, as well as comparative calculations. So effectively what we're saying is, okay, if you go down option 1 or route 1, then these are the advantages, the benefits, these are the drawbacks. This is your current tax position, this is your end tax position, after 1 year, 10 years, 15 years. That's route 1. Route 2, route 3. So it's options that we're providing to the client. Sometimes there might just be 1 or 2 options. Sometimes there might be 4 or 5. Okay, it's again very driven to the client's needs and objectives. Very quickly, we realized, following comparative calculations, that there were large tax savings to be made, very significant tax savings. We're looking at in the region of roughly £30,000 per annum between husband and wife in income tax, and over 5 years that would quickly reach £150,000 and could potentially be more depending on the tax brackets. The other issue that always needs to be considered when we're looking at properties and looking to incorporate into a limited company is around capital gains tax and stamp duty land tax. These are two key areas that must always be assessed, because one may achieve the income tax savings, okay, but then if you have to pay significant amounts of capital gains tax or significant amounts of stamp duty land tax, then one must question, what is the best way forward. I have had clients, so I've got a current client right now who will qualify for capital gains tax incorporation relief, but not stamp duty land tax relief. So, but he's undertook his own calculations with his lawyer, and it effectively is LBTT. It's not stamp duty land tax, it's LBTT, which is in Scotland. But he's happy to take the hit because he, his fiance and his mother at this moment in time is not interested in bringing them in as partners. Just keep in mind that the stamp duty land tax relief is only available for partnerships. So we assessed the situation. Effectively this husband and wife, they had been running a deemed partnership in the from the get-go effectively, but we still formalized. We went ahead and formalized the partnership. So that was effectively phase one. Following from there, we then undertook a detailed analysis. And just keep in mind that, sometimes people have this misconception that it's straightforward and it's easy. It's far from it. There are always nuances. There's always something that needs to be monitored, whether it's, dealing with the mortgage lenders, whether it's family issues, any other hiccups. Everything needs to be looked at in the round. And if you have a little knowledge, then it can quickly become detrimental. We've seen these type of cases as well. So it's always best to take formal, professional, expert advice. Effectively, we then incorporated, and one of the objectives, or another objective of the parents, was to pass on the assets or the property portfolio to the son and daughter. So they have a son and daughter in their 30s. And this is effectively another phase. So we have phase one, the formalization of a partnership. Phase two, we have the incorporation. And now phase three is where we're looking at introducing the children and or the grandchildren in certain circumstances. And just keep listening because we do introduce the grandchildren as well. And phase four is effectively around inheritance tax plan. Now, usually what we look to do is introduce alphabet shares. So effectively, the family investment company structure. We look to introduce alphabet shares, and we look to explore the growth and freezer share structure. Now, the freezer shares are particularly important for inheritance tax planning purposes. Effectively, what they do is they freeze the value of the shares at the date of, effectively at the transaction date, effectively at the date where we set up the shares in a certain way. So effectively, the share value is frozen for inheritance tax purposes. Why is that beneficial for clients? It's particularly beneficial, especially if you know that there'll be future growth, okay? Because that future growth is immediately, that's the keyword. So no 7 years, we'll come to the 7 years, but immediately outside one's estate for inheritance tax purposes. And just keep in mind that HMRC did set up a unit to investigate these family investment companies back in 2021, and this unit was closed down. So there's no issue with this type of planning. So the freezer shares are usually introduced for the founders or the owners or the settlers, whatever you want to call them. And then we have the growth shares, which is effectively a mechanism to bring the son and daughter into the picture. And this is what we done, or this is what we implemented for this particular client, and we've done this for, or we've explored this route for many clients. The other angle that we considered, I'm not sure if I mentioned the value of the portfolio of properties, but we're looking at 3.5 million in terms of the value of the portfolio. And therefore, even if we were to freeze the value of shares as at incorporation date, don't think that family investment companies, you wave the magic wand and there's no inheritance tax payable. I think some have this misconception as well. What we then had to do or explore is how do we reduce this 3.5 million? As of now, what we've implemented for the client is the transfer of shares into a newly formed discretionary trust. And again, that's a whole nother area which requires expert tax advice. This whole scenario that I've explained, it's a case study, it's something that we implemented for our client. We're still working with the client because, they have their two trading companies. They have a lot of other angles that need to be monitored. They are possibly looking to relocate overseas. So our engagements with clients is not just, throw out a solution, implement it, and that's the end of the matter. What we prefer to do is, we have the initial discussions and we work together. So we're with you on your journey. I hope you found the information interesting and beneficial and useful. As I say, property tax, inheritance tax, obviously income tax, capital gains tax, stamp duty, land tax, and then corporation tax, trust taxation, all these taxes we can manage, and we do manage for our clients. As I say, we are a multidisciplinary practice and a firm of chartered tax advisors regulated by the Chartered Institute of Taxation. I hope you found that beneficial. Don't forget to like, comment, share, and subscribe, and I shall speak to you soon. My email address is down below, omar@aswatax.co.uk, and you can also visit our website. Cheers, bye.